In a stunning turn of events, Warner Bros. Discovery stock soared to a 52-week high after the company announced it's exploring a sale. But here's where it gets controversial. Is this a strategic masterstroke or a desperate move in a rapidly shifting media landscape? Just as Netflix's earnings report loomed, Warner Bros. Discovery, WBD, dropped a bombshell. Its board is reviewing strategic alternatives to boost shareholder value, sparking a frenzy of speculation. But this is the part most people miss. The announcement wasn't just about selling the whole company. It also hinted at potential splits, spin-offs, or mergers that could reshape the entertainment industry. Could this be the beginning of a new era for Hollywood giants, or a risky gamble that backfires? The news comes after weeks of whispers about WBD's future, led by CEO David Zaslav, who acknowledged the growing interest in the company's portfolio. But what does this mean for the average investor or media enthusiast? Let's break it down. The options on the table. WBD laid out several possibilities, including 1. Continuing with its planned split and spin-off. 2. Selling the entire company in one transaction. 3. Breaking off separate deals for Warner Bros. And/or Discovery Global. 4. A hybrid approach, merging Warner Bros. And spinning off Discovery Global. But here's the kicker. There's no timeline for this review, leaving everyone guessing. Analysts, however, aren't holding back. TD Cowen's Doug Kreutz called the announcement a formality, suggesting talks with potential buyers were already underway. His bold prediction? A deal with Paramount Skydance is reasonably likely, though he doubts more attractive bidders will emerge. Do you agree, or could a dark horse bidder surprise us all? Benchmark's Matthew Harrigan upped his WBD price target from $18 to $25, arguing the stock's free cash flow potential post-2025 justifies the optimism. He and colleague Daniel Kurnos are betting on David Ellison's Paramount Skydance as the frontrunner, despite Larry Ellison's possible reservations. But is this merger a match made in heaven, or a risky bet on old media? Bank of America's Jessica Reif Ehrlich echoed the bullish sentiment, reiterating her buy rating and $24 target. She believes WBD's premium IP and robust library make it a prime acquisition target, especially for Warner Bros. But what about the regulatory hurdles? And could unsolicited offers complicate the tax-free split WBD previously announced? Guggenheim's Michael Morris raised his target to $22, citing consolidation potential and asset value. Meanwhile, MoffettNathanson's Robert Fishman highlighted Paramount Skydance as the most strategic fit, thanks to IP synergies and platform consolidation. But what about Comcast? On paper, it's a perfect match, except for one big problem: regulatory and political headwinds. The controversial question: who's the real winner here? While Paramount Skydance leads the pack, Fishman suggests a private equity Sony partnership could be another path. Yet he downplays bids from Netflix, Amazon, or Apple. But what if one of these tech giants surprises everyone? And what does this mean for the future of streaming and traditional media? As the drama unfolds, one thing's clear: WBD's move has ignited a debate about the future of entertainment. Is this the end of standalone media giants, or just the beginning of a new chapter? Share your thoughts in the comments. Do you see a Paramount Skydance victory, a Comcast upset, or a completely different outcome? The floor is open.